En medio de todos estos frentes vamos a aprovechar para hacer un análisis de la situación de los mercados. Tenemos con nosotros al Senior Research Analyst de sentimenttrader.com. Vamos a hablar con Jay Kaeppel. Jay, thank you so much for having us a few minutes.
Hello. Thank you very much for having me on.
Jay, we are awaiting the CPI data this Friday. Inflation is still one of the main uncertainties driving the markets. April US CPI moderated for the first time in 8 months to an annual pace of 8.3%, and now we are awaiting the May inflation data this Friday. What could we expect, and how are you seeing investor sentiment?
Well, we try to keep it as simple as possible. In terms of the market, there's certain factors. Right now, there's a lot of investors out there that are very confused and very concerned, and that's understandable given the nature of the indicators. So make it real simple. There's sentiment, price action, interest rates, inflation, and the overall economy. So in terms of sentiment, the indicators that we follow at Sentiment Trader, we're starting to see some favorable signs. In other words, people giving up, people throwing in the towel, getting bearish, which on a contrary basis is bullish for the market. However, what you have to see is some capitulation and also some follow through by the market itself. So if we look at price action, right now all of the major averages are below their long-term moving averages. That is the textbook definition of a downtrend, which means to me it's not the time to be a hero in the stock market. So to keep it as simple as possible, what I always suggest to people is if you look at the S&P 500 index versus its 10-month moving average, above is good, below is bad. And you just keep that in mind. Right now, it's below, so that is a negative for investors to keep in mind. Looking at interest rates, I look at the yield on the 10-year Treasury note here in the U.S. versus its 7-month moving average. And when it's below that average, that's good for stocks. And when it's above, it tends to weigh on the market, and that's where it is right now. So that's another negative factor. And then inflation, of course, is the word on everybody's lips around the world these days. And we did a study, and what we found is when looking at the consumer price index 12-month change here in the U.S., when it's below plus 4%, and above minus 4%. That's kind of the sweet spot. That is moderate inflation. The stock market loves moderate inflation. When it gets outside of that range, as we've seen in the last year, it's definitely a negative for the stock market. One thing to keep in mind, though, for investors to look at, we did another study, and when the inflation rate is above 8%, but it ticks lower from month to month, very often the stock market reacts positively because the stock market is a discounting mechanism. So if it perceives that inflation is going to decline, it's going to abate a bit, even if it's still at a high level, the market can surprise everybody. So we want to keep an eye on the inflation rate from month to month. And then the last thing, of course, the economy. The indicators that I look at are a very mixed bag. The one thing that concerns me, though, about 99% of everybody that I talk to or read or listen to says we are headed for recession. And I look at the indicators and I see where they're coming from. But I also know in the financial markets, when 99% of everybody agrees on anything, it almost never works out exactly the way they expect. So I've seen a lot of insider buying lately, and I just keep thinking maybe they're seeing something that everybody else isn't. Maybe they're seeing better earnings ahead. I'm not sure. But overall, what I've just described, you have sentiment is getting favorable. The economy is essentially a wash. And the other three factors, price, inflation, and interest rates, are all negative. So like I said, it's not a time to be a hero. And, forgetting all the prognostications, what I always tell investors is what you really need to do is not worry so much about what's happening next in the economy or the market, but how are you going to allocate capital? Because that is ultimately what will decide your fate. So there is no one size fits all, but just as an idea, the model that I follow right now, given the mixed bag that I just described in terms of indicators, it's 40% in stocks, mostly dividend-paying stocks, which are actually up on the year, surprisingly, 20% in commodities, which have been terrific, and then 40% in cash, which is making almost nothing, but it's also not losing money. So, like I said, a kind of a mixed bag of indicators leading to a very conservative portfolio at the moment.
So, Jay, excuse me, if we see an inflation above 8% this Friday, could we see a positive reaction from markets?
Well, like I said, it depends if it, the month-to-month change. If last month the inflation rate was 8.5% and it comes in this month at 8.2%, that is the kind of catalyst that can surprise people in the market, where the market will all of a sudden go, hey, wait a minute, it's not as bad. It's not trending. If it goes up to 9%, 9.5%, if it keeps, as long as it keeps rising, fear is going to hold back investors from being heavily invested.
Jay, you have spoken about recession, stagflation, and last week Jamie Dimon, the CEO of JP Morgan, was alerting about hurricane in economy. Today, the lead economist, of JP Morgan says he doesn't see a recession. Who should believe?
Yeah, I just. It's not a foregone conclusion. Like I said, the indicators, I have different things that I look at, and one is bullish, one is bearish, and one is neutral. So I can't join the chorus of everybody saying we're going to have a recession, but I also can't say we're in for a boom. One other thing I wanted to mention, I mentioned a 20% allocation to commodities. And I think that's really an area for people to look at. A couple of years ago, I made the comment that I think commodities could outperform stocks for a number of years. And part of the reason for that, I'm actually going to show you a chart, okay? But let me describe it first. It looks like a roller coaster. There's a red line that goes way up and way down. And it's the Goldman Sachs Commodity Index divided by the S&P 500 index. And so when this red line goes way up, that means commodities are vastly outperforming stocks and vice versa. Okay, so let me just see if you can see this chart. Let me get it on here so you can see it. I keep going the wrong way. Okay, so down at the low end here, 1970, that's over here. All of a sudden you see this huge run up commodities. We had a big spike in inflation, and all over the years you see these big up and downs. Now look over here at the far right. Here we are. This is commodities compared to stocks. You practically have to go underground to see where that ratio is. And what this tells me is that commodities relative to stocks may have a very long way to go. Okay, so the other piece of good news is back in the 70s when we had inflation, if you wanted to trade commodities, you had to trade commodity futures, which involves leverage and risk and is not for everybody. Nowadays, you can buy a basket of commodities via an exchange-traded fund. A couple of symbols would be PDBC. These are all in the U.S. GSG, DJP, GCC. All of these hold a different basket of commodities, but the point is investors can buy this just like they buy shares of stock. So it's a way to be invested in that asset class without having to trade commodities or the physical commodities themselves, which nobody wants to do that.
Jay, one last question.
Sure.
We are seeing today the reaction in target shares. We have seen how this retailer is slowing down, taking into account the last profit warning that has launched. How are you seeing all this retailer sector now in the US?
Well, the retail sector is not great at the moment. However, a study that we did a while back, we looked at periods when there was high inflation and rising interest rates, which is what we have right now. And during those environments, and we tested this back to about 1926, so it's a very long history, the top three performing sectors when you have high inflation, rising rates were energy, which has been terrific so far this year, healthcare, which we're seeing a lot of interesting signals in the indicators on our website for the healthcare sector. And then the last one is consumer staples. So retailing fits more under consumer discretionary, but staples are, the things that everybody has to buy. Those three sectors are kind of where I'm focused right now. One other one to kind of put on the list, I don't know that this is exactly the moment, but I'm seeing a lot of parallels right now between where the energy sector was 2 years ago. Unwanted, unloved, beaten down, nobody wanted, and now today it's the only sector that's performing well. Between energy and back then and the biotech sector today, the biotech sector has just been absolutely beaten down. Nobody wants these stocks right now, and that doesn't mean they're going to turn around right away, but I do think a couple of years from now, we're going to look back and say that this might have been a good time to take a look.
Jay Kaeppel, thank you so much for this analysis.
Thank you very much for having me.